Hello and welcome to another episode of VAT Update from Tax Essentials for Advisors. I'm Ed Thompson. This week we'll be looking at a new zero rate for domestic electricity. We'll look at cases on relevant residential purpose buildings and economic activities. And we'll do a VAT tip on claiming bad debt relief. As I'm sure you're aware, since our last update, we've had a new Prime Minister, and that was pretty much the first thing on his agenda as a cut in VAT on household electricity was announced. Now, domestic electricity is already subject to VAT at 5%, but now it's set to be reduced to 0%. It looks, though, like it won't be possible in Northern Ireland because of EU VAT rules that still apply in some capacity there. It also looks like the existing VAT reduced rate, the 5% rate for electricity, will be used as the template for how this 0% relief will apply. That means that as well as applying to domestic supplies of electricity, it's also going to apply to certain supplies to charities as well. Now, the VAT relief for fuel and power is generally not that well understood by charities, and it only applies where a charity is using the electricity for VAT non-business purposes. However, in light of the announcement, it is very much worth charities reviewing their entitlement for this VAT relief, as it can be a very valuable saving. Now, our first VAT case concerns the construction of a secure mental health facility, which is for youngsters between ages of 12 and 18 suffering from mental disorders and usually convicted of violent offences. And the question is whether the construction of this facility could qualify for zero rating as a relevant residential purpose building or RRP building. Specifically, it concerns whether part of the building, the bedroom wing, was being used for an RRP. Now, that law allows certain kinds of buildings construction to be zero rated, and that includes the construction of new dwellings, certain charitable buildings, and also buildings that are intended to be used for certain residential purposes or relevant residential purposes, like, for example, care homes. And the law lists out various types of use that are considered a relevant residential purpose. But this concept of RRP specifically excludes use as a hospital, prison, or similar kind of institution. Now, in this case, the taxpayer failed to convince the upper tribunal of its entitlement to this RRP relief because the bedroom couldn't be divorced from the wider facility of which it was part, which was a hospital, and it couldn't just be considered as a bedroom wing in isolation. And that was reinforced by the fact that medical treatment occurred throughout the bedroom wing and it lacked some of the core features of residential accommodation, notably eating facilities. Our other case that I want to talk about today is about one of these very important VAT concepts, which is the concept of an economic activity, which sometimes is also referred to as a business activity. Now, in broad terms, if an activity is an economic activity for VAT purposes, then only then will it be within the scope of VAT in the first place. And only if an activity is an economic activity can VAT on costs be recovered. And the facts here in this case are relatively complex, but in broad terms, there was a UK VAT group and it sold an operating business in 2017, but kept some intellectual property and assets which were eventually sold in 2022. And the tribunal held that in the period in between the sale of the operating business in May 2017 and the sale of everything else in 2022, the group had ceased to have an economic activity and couldn't demonstrate that it intended at that point to have an economic activity in future. However, the sale of assets in 2022 effectively reignited the business activity in relation to that one instance. And this causes some complexity for VAT recovery that wasn't fully ironed out in the decision. if VAT was incurred on ongoing costs between 2017 and 2022, that may not be recoverable. But if VAT on costs could be shown to have a direct and immediate link to the sale of the assets, which was an economic activity, then it would be recoverable. A final VAT tip to leave you with, and it's the scenario where a business has accounted for a VAT on a sale, but doesn't receive the payment from its customer. And in these circumstances, it may be entitled to bad debt relief. However, bad debt relief is one that many businesses forget to correct and end up not adjusting the VAT declared, even though they may well be entitled to do so. And therefore, they're leaving VAT on the table. Now, you need to check that all the conditions are met for bad debt relief to be claimed. Broadly, that means you must have actually accounted for VAT on the supplies in the first place and paid it to HMRC. You must have written off the debt in your day-to-day VAT accounts and transferred it to a separate bad debt account. And also 6 months have to have elapsed from the later of the due date for payment and the time of supply. But make sure that this bad debt relief is being claimed where it's entitled to be claimed and the VAT is not being left unclaimed. As I say, many businesses end up never getting this benefit. That's all for this episode, and I look forward to catching up with you again in a couple of weeks' time.
Thanks, Ed. The tip was insightful as ever. Just a quick reminder that we will be hosting another free CPD accredited webinar on the 26th of August. This time the topic is tax-free benefits and the opportunities and traps surrounding these, and our special guest is Jack Bonehill, Chartered Tax Advisor with PKF and host of the Tax Professionals podcast. Use the link below to register. Hope to see you on the day.